Hi, all. Thank you for your patience. Welcome to our review on the LIPA UK fund market for the half year 2024. Today, I have Dewi John, our expert on the LIPA fund market, with us to give us further insights. Over to you, Dewi.
Great stuff. Can you hear me?
Yes, loud and
Fantastic.
clear. Thank you.
There's the novelty. So there's for those of you that haven't been on one of these quarterly updates before, it breaks down into well, first of all, aren't you in for a treat? But it breaks down into three components. One is a brief macro overlook. Two is the UK fund market in the last quarter, and three is year-to-date sustainable fund flows within the UK market. So within that, let's kick off. And are the screens transitioning? So as I was saying to Livania before, I did this once. I went through the whole presentation. Nobody said a thing. I could see the slides fine, and nobody else could see anything. So is this
all good?
We're on macro outlook now, yes?
Yes.
Wonderful. Okay.
Thank
so,
you.
They're the main points. I won't read through them. Basically, things are starting to normalize. All the crazy stuff from post-pandemic, and then the additional shock of the mini budget seems to be feeding through the system. Those are the four examples I've given, and I'll prop that up a little bit in a minute with the examples. I won't read through the bullet points. They're unexciting enough as it is without the repetition. So what are we looking at? First of all, I think the more interesting slide, I mean, the left-hand slide, policy rate, bank rates are pretty much common knowledge. But I think the right-hand side is quite interesting, UK real interest rates, because this looks to be a return to normal. Heavy, ironic, inverted quote marks there. Really, since we've lived in the old new normal world of the post-financial crisis situation, where real interest rates for the most part were negative, and that drove a very particular large cap and growthy environment, which was almost kind of a one-way bet for well over a decade, that now seems to be fed through. Are we returning to something that looks more like the pre-2007 world? I'm dubious. I think lots of other things in the picture have changed. So it'd be rash to just say, are we investment prescriptions that worked 15 years ago and haven't worked subsequently will now work again? But certainly, if you look at that, there's a change in the environment that we've not seen, in the fundamental macro environment that we've not seen for quite some time. Another positive slide, and again, for those of you who've sat on these calls before, I'm not Mr. Optimism, but I think this looks quite interesting. It's a continuation from what I pointed out last time, in that CPI is moderating. Core CPI is still rather stickier, but we're seeing regular earnings in both public and private sectors. And obviously with the public sector, we had over the past few days the announcement that Rachel Reeves is signing off on public sector wages significantly ahead of the rate of inflation, where public sector wages have tended to be compressed since about 2010. This is now a change in environment. Positives and negatives to that. Positive, obviously, is it's good for aggregate demand. Could be a inflationary stimulus. But I think if you look at the data, to be honest with you, real wages tend to lag inflation. Nominal wages, tend to lag inflation rather than lead it. In general, so I would see this as be cautiously. I'm breaking in these teeth for someone else. Cautiously optimistic about this trend. Another interesting chart. We're seeing, again, you look at all the massive volatility that we saw around the outbreak of COVID and then the exit from COVID, much higher than around, if you sort of look at the blue schedule in the middle of the graph, much greater than we saw even in the financial crisis. That seems to be now returning to the long-term trend. Again, too short a time to say with any confidence as to how on trend that is, or whether we're looking at a blip or not. But it seems to be a reasonably positive sign of a return to normality, and the real consumption is back where it's been for the most of the period on this data. I think what's interesting around that as well is if you compare to real consumption, how massively volatile house price inflation is over that whole period. More so obviously around the GFC, but in general, there's little correlation with real with earnings and real consumption. Next, business investment. See, business investment overall is going down. However, manufacturing and services investment is on something of an upward trend. I think the worrying schedule here is obviously what's happening in business investment, which I take to mean everything that's manufacturing and services. The positive thing on this, of course, is how strongly upward we're seeing the key driver of manufacturing investment head upwards. Just a side note, if anybody wants to chip in either on the notes, Livania, if you can tell me if anything appears on the notes, because I can't see it at the moment, but also just unmute yourselves and ask a question. I'd be really happy to deal with that, because frankly, I get really bored of the sound of my own voice. And yield curves. Japan, because of its very distinct environment, it's been massively positive. Unlike other G7 economies, we've had a tendency over the past couple of years for curves to be inverted. For the UK at the moment, we've seen the curve turn positive again. In general, that's because of short-term rates have come down rather than long-term rates have gone up. Both. If we look at July 23, 2-year yield curve is 5.2, 10 years 4.7. So that's a little over around about a year ago. Negative yield curve. Now we have 2-year gilts at around 3.8, 3.9. So they've come down a lot despite short-term interest rates remaining static, whereas the 10-year gilt has come down a lot less. It's gone 4.7 to about a few basis points above 4 over those 12 months. So that's what's caused the current positively sloping yield curve. Shifts at the short end of the curve rather than anything happening at the long end. That's a macro overview. I don't know if anybody's got any views on that, questions or challenges to that brief skim through of the UK economy. If not, we will bounce into UK ETF and mutual fund flows over the second quarter of the year. Less of the backdrop, more of the meat here. Again, positive flows, but the bulk of that action is in fixed income and passives, and that has a multiplier effect, if you like, with passive fixed income funds. All other asset classes in the round have struggled somewhat, and we'll get an indication of that a little further. But let's see what's been driving markets. When we looked at this chart 3 months ago, The UK was a lot further down the rankings, although importantly, and I'm looking at the left-hand side at the moment, equities. The blue bars show the 3-month view. The grey bar is year to date, which is 6 months, and this is FTSE Russell data. So the US, of course, no surprise, is leading the market. All world is not far behind that, particularly on a year-to-date view. That should be of no surprise because the US is such a large component of all world indices. And I think what's interesting here is that right at the bottom left-hand side, you can see whereas Japan, last time we looked at this, had been neck and neck with the US, sometimes ahead, sometimes behind. We've seen that reverse over the past 3 months, and you'd have made losses on Japanese equities over the past quarter, which is dragging back its longer term figures after really quite a strong run over 12 months. Gubbies, again, you're in negative, despite the fact that we've been trumpeting now, or the fund management industry be trumpeting for the last 18 months that bonds are back, unless you're putting your money in Chinese 7 to 10 year bonds, and this is where all this is long-term debt. You'd be still nursing a loss on that. Onto the corporate bond market, it's that riskier end of the curve that's delivered the best returns. Emerging market high yield ahead of US high yield, followed by emerging market investment grade. And again, still in negative territory, US investment grade and European investment grade over both 3 and 6 months. So again, there's not been a significant bounce back, despite the fact that, the mood music is that this is a good entry point into fixed income. We've yet to see that turn into, certainly within developed markets, into positive results. That said, as you can see, I'm just going to flip through a little bit before we get to it. You can see a lot of action there within passive bonds, but we'll come to that in a second. So that's equities and bonds performance, sector view on equities. And again, I'm not going to spend too long on this chart, just top right hand corner, you can see very clearly, and again, no surprises, all world ex UK. UK is the blue bar, rest of the world is the grey bar. It's tech that's driving it. Really, apart from that, it's like within the right hand chart, software and computer services are lagging that a long way. And I know there's a lot of talk in the market, which is quite interesting, that expectations that the rally will broaden out into those corporates that can take advantage of the very narrow AI-driven rally, and that should affect software and computer services and businesses like this. It's still a long way behind. That said, if you look at the UK, even though the UK is still significantly unpopular at the moment, banks have done pretty well. There's nothing else in the all world ex UK that comes anywhere near its returns over the past 3 months. It's a very, very quick drop off there. So that just indicates what pundits have been talking about throughout this year, that this is really a pretty narrowly based rally. Looking at the losers within this, I don't think there's anything to comment on massively here. No significant drop-offs. I just note with disappointment, bottom left-hand corner, again, the blue bar, that's the UK. Beverages are lagging way behind, despite my gallant efforts. But I don't think there's much else of any particular note within this. So we shall move on to the next one. UK fund flows by asset class. So this is over 30. Each one of these bars is 1 month. Each one denotes, it's broken down by asset class. You can see the bit roughly in the middle of the chart is October 22. That huge sort of bluish turquoise bar, that's the institutional market dash for cash as a result of the mini budget, and it dominates everything else. You pretty much got to squint at the rest of the chart to see what's going on there. So looking over on the right hand side of the chart from January 24 onwards, it's interesting that I think that up until that point you'd seen that massive chunk of cash, which is way, way bigger than any asset class shifts that we saw, even in the global financial crisis. It totally dominates that. And then you get that feeding back into the market. If you were to compare this with the European flows at the same time, you'd see throughout the end of 22, all the way 23, actually investors were deploying capital into money market funds. The reason being that you had inverted yield curves, you had a good yield on cash, good risk return profile. Certainly, why go into bonds when you'd be making more at the short end in money market funds? The UK behaved completely differently. That's kind of fed through now throughout the rest of this year, but you can see cash is moving rather erratically month to month. There isn't a particular pattern within that. You see a similar thing with equities, which is the red part of the bar there. Sometimes positive, sometimes negative, as we'll see. In generally, it's washed out as negative, but you haven't had a clear trend emerge, despite the certainly positive first half run for equities overall in return terms. It hasn't really been that clearly reflected in flows. The standout here, apart from last month in June, where there were significant redemptions from bond funds, is it's been very much the year for bonds. And if we look at Q2 here, you can see how that plays out. So the real big winners here are bonds, but bonds in funds. Equity, significant outflows, but again, there's a churn from active into passive, some action into alternatives, but again, not much action there. And real estate continues to be something of an ongoing nightmare. Nobody wants real estate at the minute. Focus briefly, there's a return to favour on a small level for mixed assets. That hasn't been the case. That is, as we will see in the next chart, if you go back to the fourth bar here, that's GBP aggressive. We're seeing deployment of capital into aggressive funds, but we're seeing redemption into the more bond heavy, conservative, and particularly balanced classifications. Why do we think that's happening? Well, it seems to be that since the global financial crisis, because of the insubstantial yields on fixed income, that investors have been using mixed asset funds, and particularly more cautious mixed asset funds, as bond proxies. So you get your bond allocation, but you get a little bit of a kicker to boost the returns from equities. Now with the rotation back into bonds, that trade has reversed, and we're seeing people sell off balanced and conservative and go back into pure fixed income plays. That doesn't really apply to mixed asset mixed asset aggressive, because the bond component is too low. Again, I keep saying, I say this every 3 months, and I'm always interested to see if anybody's got an alternative perspective, but it seems to be the one that's stuck. Equity global, working our way through, and equity US still very much at the sector level, classification level rather, driving the market, even if flows overall are out of equities. What I also think is interesting, despite the rotation from active into passive, you're seeing active strategies take the vast bulk of the money of equity US. Now, I've looked at that on a month-by-month basis. And when this first started to happen, I went, oh, it's just a single fund action. You'll see one or two share classes um, uh, driving this, which leads me to think that this is all because essentially of a handful of big institutional investors making an asset allocation shift that benefits one fund manager. But it keeps happening month after month after month with different funds, even if one fund or one or two funds or one or two share classes tend to dominate this on a month by month basis. So it's an interesting process, and it's bucking the market, but it isn't. It's more than one particular fund dominating it. Despite the disappointment of Govy returns overall, particularly in developed markets, seeing there on the fifth bar, UK Govey's doing pretty well. Also, third biggest allocation, again, all passive and more global bond global USD, dollar global bonds, doing extremely well in this environment. Equity Japan as well, just to remark on there, considering its strong run up to the end of Q1, has still done very well throughout Q2, despite the disappointing performance. Where are the redemptions happening? Surprise, surprise, Equity UK split between passive and active strategies. Equity Income UK is there fourth on the list. Irrespective of how the UK market does, we're still seeing that sell-off that's been going on really since the start of the millennium, and it seems to be fairly impervious to the impact of performance. Again, illustrating my earlier point, you can see the third bar along mixed asset balanced have sold off, and if you went further down, you'd see that conservative is in negative territory as well. Interesting, again, despite their relatively good performance compared to other fixed income classifications, high yield not doing particularly well. Last chart on the broad overview for Q2 of the UK market. The fund management companies, so the major beneficiaries, you see up on the left-hand side, they're all three big passive players: BlackRock, Vanguard, State Street. Interesting, Royal London down the other side has done, but while it's done very well for its bond and particularly cash over the quarter, it's rather unusually had been in negative territory for equities. So before we jump into the sustainable market for H1, any points or questions on that? We'll like to pause for breath and get a drink. No, off we go. Main points. Another positive quarter, positive period H1 this one, isn't it? For sustainable funds in general, we're using quite a tight darker green, if you will, definition for sustainable assets here, rather than just, for instance, engagement or the like. Equity US done extremely well. That's a relatively new thing, which was never previously considered as the place where you saw sustainable action. And again, a good period for passives. That said, while we're in positive territory, you can see a general trend downwards from middle of 21. Why do we think that's happening? Well, I suspect it's very much because you had an investment environment that very much benefited ESG up until the turn of the decade. That sort of negative real rates benefiting growth-orientated companies which tended to many which had an ESG slant. So you had a performance kicker to that, which has not been the case, or certainly not so clearly been the case in the ensuing period. So you've seen that trail off. That said, any given quarter, it's always been positive. So when does it turn negative, or what could drive it upwards again? Don't know, but we don't seem to be getting a return to that negative real rate environment that was so beneficial to these strategies as of 3-4 years ago. H1 figures in terms of sustainable versus conventional. Again, the major beneficiaries, despite the fact that this has been very much a bond market, whether it's in positive territory, conventional bonds have taken the majority of the money there, but you've got 8+ billion going from conventional strategies into sustainable strategies over the period, and that's really what dominates the trend. If we'd have looked at that in the previous quarter, if we'd looked at that throughout 2023, with the exception of the third quarter, I think you'd have seen something that very much looked like this, particularly within the equity space. Who have been the beneficiaries of this? Equity US. So again, if you map this against what we just looked at in terms of active versus passive, you can see sustainable active managers are really what are taking the money on a more granular level. In general, what you tend to see is, with this side of the market, with the exception of the US, sustainable funds seem to be riding on the coattails of a general flow into particular classification. Exceptions are, of course, real estate global, where sustainable funds are in positive territory, bucking the market, bond global GBP, and bond global corporates Europe. You see, looking right on the right hand side, just a brief note, mixed asset GBP aggressive. There's very little sustainable action going on there. I think that's quite interesting, because if you'd have looked at this up until about 21, the bulk of that bar chart on mixed asset aggressive would have been green, but there were two players very much dominating that market, the mixed asset market over to that point. They took a hit in performance terms when the market turned, and we've not really seen funds of that style come to prominence again subsequently, despite the fact that in many cases I think performance has recovered. The flows haven't followed suit at the moment. Negative.
Hi,
equity.
Dewi.
Hello.
Sorry to interrupt. We have a question.
No, that's all right. Go ahead.
Dewi, is that coming from maturation of sustainability over the past 2 years?
Is what coming from maturation of sustainability?
That's my question, if you don't mind me jumping in.
Yeah, no, please go ahead.
Just because I'm over at UK Sustainable Investment and Finance, and I'm wondering if some of that is coming from almost maturation of how sustainable investing has evolved over the past 2 years. In 2021, I think this was long before, we've had an anti-greenwashing rule come into force at the end of May from the FCA. Do we think that that has anything to do with the way that this is represented now? Just how the industry has shifted and how the industry is interpreting sustainable investing, clarity around greenwashing.
Yeah. Thanks, Madison. That's a really good question. The honest answer is I don't know, which isn't very helpful, but there's a lot of moving parts there. I think that's certainly had an impact. I think, as I said, performance has had a significant impact. In terms of maturation, as I said, the definition we're using here of sustainable investing is really quite tight. If we'd have used a much broader one of integration, the last time I checked this, I think you'd have seen a lot of these positive bars be in negative territory. And the reason for that, I think you're seeing, and that is down to, I suspect, a lot of it down to the greenwashing rule, that a lot of investors are not wanting to be caught on the wrong side of this. You know, if you're a pension fund trustee, for instance, and the like. So they are getting out of possibly more questionable sustainable assets into darker green assets, and I think that's what we're seeing. SDR will, I reckon, and I'll be interested to hear what your view is this, because you're much closer to the market on this than I am. I think that will accelerate that drive because the integration category, in effect, is excluded from SDR, and I suspect you will see, excuse the bad pun, but the market not messing with Mr. In Between anymore. And this trend will be driven. But I don't know what I mean, Madison's on the call from UCSIF, and she's got much more expertise on this than I have. So I'd be really interested to hear your view on
We need to talk about this in about 3 or 4 weeks, I think. As we approach that July 31st deadline, let's see what the regulator says. I think there are some interesting conversations going on behind the scenes at the FCA on what's happening with funds. But we'll hold the line. We should talk about this in a few weeks and see where we're at. But right now, I think things are up in the air at the moment.
I would definitely drop you a line on that. And I've been hearing some strange things anecdotally as well. So yeah. Thanks a lot. Cheers. Any further questions on this bit so far? And thanks, Madison. This is really interesting. Okay, so here, I've lost my slide now. There we go. Negative flows. I don't think there are any interesting contra indicators there. Generally, I think what we're seeing is where there are negative flows in sustainable assets, it tends to be just collateral damage on broader asset movements. The one exception there is bond USD govies. I'm just going to ascribe that to one of those things. I mean, what's a sustainable US government bond, for God's sake, or in dollar denominated government bond? But if anybody has a strong view to the contrary, again, chip in and show me where I'm wrong. The only real exception here is the second bar, equity theme, alternative energy, and to a much smaller degree, equity themes, water and agribusiness, more water than agribusiness. I'll come on to that in a minute. That's because of their debt-like characteristics and how they've been hit since COVID. But we'll look at that in a second. This is active versus passive. Insofar as there's anything interesting going on here, I don't think there's a clear trend emerging, apart from it in the latest bars, because the colored bars here are passive, and they just go, they've shifted around since I started this data run from the first quarter of 22. But passives have performed very, very strongly over the second quarter, both in fixed income and in equity, in a way that they haven't before. Now, at the moment, I'm just going, that's a blip. I can't see anything that's particularly driving it, other than, passives are making inroads into all sorts of markets. But what should have accelerated it over the past quarter? I have no, I can't see what's done it. So I'm ascribing to that as one of those things. If the same things happens into the next quarter, I will have to substantially revise that opinion. But let's see. It's as Cho and I said, it's too early to say. What is interesting here, and these again, this is FTSE Russell data over 3 and 6 months. These are sustainable indices. There's a lot going on here. It's very busy. You'll be pleased to know I'm not going to talk you through the whole thing, but we're going to look at what the little red outline bars here that takes us back to alternative energy. Alternative energy been a basket case since rates shot up for obvious reasons. Again, they've got fixed income characteristics. They're heavily debt laden, and that's, they're bond proxies rather, and they're heavily debt laden. They got carried out as rates shot up. Now, if you look at year to date, the red box on the bottom right hand side, you can see there is significant losses there. They're the worst performer. If we look over the last 3 months, however, that has, and frankly, if you looked over the last 18 months, 2 years, that would have looked pretty much the same. That doesn't look too bad. That surprised me. So are we now seeing an end to the punishing environment for renewables and alternative energy stocks? Well, when the news is no longer quite as bad as it's been, that's kind of good news in its own way. So I'll be interested to see, A, if this trend continues, and B, if that then starts to feed back into alternative energy flows. But I think all the various things that are going on here, that's for me the most interesting part. Lastly, final slide as well. I mean, good God, look at this. BlackRock, through not just equity, where it dominates totally, but also its bond flows alone are greater than the total flows of all the other players on the table. And once you get down to the bottom, to the right-hand side of that table, you're particularly with my old eyes, you've got to squint to see what's going on there. I need to refer back to my Excel table it's drawn from to say anything at all about this. And that, as I said, is that. Any further questions? Particularly the hard ones. I always like those, even though it makes me stutter online. Don't be shy. Well, if there isn't, I'd just like to thank you very much for your time. Any further inquiries for
looks like
LIM
we
resources?
are...
Please go in.
Sorry, I think we are getting a question in the
let's go then.
chat.
Shoot back.
Just
let me see if I can see.
Sorry, before we close off,
fine.
I can see someone typing, so just wanted to interrupt just as we wait for the question.
You can always unmute and do it sooner. Indica. Let's just hope it's not a really long question.
Oh, thanks, Indica.
Right. Just wanted to thank you. Thank you very much as well.
Thank you so much. Sorry to put you on the spot there. I just didn't want him to close the call with an unanswered question.
Thank you. Yeah. Thank yous are welcome as well. I've got a fragile ego that needs massaging.
No, that was wonderful, Dewi. So, Dewi, so insightful in terms of the variations in fund flows. It's really interesting to sort of like watch the space. Let's see what the next quarterly report holds for us, and if we can draw any any more sort of hard and fast conclusions in terms of where things are going.
Brilliant. Yeah. As I said, some interesting indicators of what may or may not be happening the next quarter, but it's always the case, isn't it? If memory worked more than one direction, I would be a very rich man, as would we all.
Yes. Yeah, but still really important to discover the relationships, which we really appreciate from you, Dewi. Thank you so much.
Cool. Thanks a lot. And thanks to everybody that gave their time over for sitting in on the call today. Much appreciated. Cheers.
Thanks, everyone. Have a wonderful day. Bye.
Cheers.